Hey guys, welcome back to the channel. In today's video, we're talking about a closed corporation. We'll talk about what they are, some of the pros and cons of running one, and how to start one for yourself. If at any point you want to check out a business formation service that can help set up your business for you, check out the affiliate link that's down in the description. There you'll get a discount you wouldn't be able to find anywhere else. So that being said, what is a closed corporation? A closed corporation, also called a closed corporation or closely held company, is a type of corporation that has a limited number of shareholders, operates more like a partnership, and holds their business privately. Some closed corporations you may have heard of are Chick-fil-A, Mars, and Hobby Lobby. Now, when we look at a closed corporation, we'll notice in terms of shareholders, they're on the smaller side. Typically, shareholders are often made up of family members, business partners, or a small group of investors. Some states set a maximum number of shareholders to qualify as a closed corporation. I've seen the states that do set the line at 30 shareholders. Closed corporations are common among family-owned businesses. Although being related is not a requirement, this structure is ideal for owners who want to maintain control and a bit of privacy as well. You see, closed corporations aren't publicly traded. To be publicly traded means that a company offers shares of their business through stock to the general public through some type of stock exchange, like the New York Stock Exchange, for example. In a nutshell, it means the company's shares are available for anyone to buy and sell on the open market. Companies that trade publicly, more often than not, have stricter federal regulations in order to protect shareholders and ensure the business is keeping them in the loop. In a closed corporation, public trading isn't a thing. Closed corporations don't trade on the stock exchange. Actually, they don't offer stock to the general public at all. That means you or me, we couldn't be investors unless we had some connection to the business. Instead, shares are usually held by the owners or managers of the business, and sometimes even their families. Shares to the business may be found as part of an inheritance. Now, because the pool of shareholders is much smaller in a closed corporation, the level of regulation is not as high. Now, just because there may not be as many shareholders in a closed corporation doesn't mean shares can be sold or transferred willy-nilly, even by existing shareholders. For example, say I'm a shareholder in my family's grocery store. If I wanted to sell or transfer my shares to a friend, I would need to offer my shares to the other shareholders first. If they decline my shares, then I could bring up the transfer of them to a friend. Now, that doesn't mean it's a done deal. No, the other shareholders or board of directors would need to hold a vote on that transfer. Now, setting the value of the share or shares is a multi-step process. To determine a price, the corporation has to consider the company's financial performance, assets, future prospects, and recent sales of similar businesses. Now, this is a simplified scenario. In any closed corporation, there is a buy-sell agreement in place that outlines the process of transferring shares. These agreements help set up the conditions that shareholders can sell their shares, who can buy them, and at what price. These agreements help the business maintain control over ownership and prevent transfers to outsiders. This closeness among the shareholders is part of the reason closed corporations' management style is more informal compared to publicly traded companies. Their reporting requirements are more simplified, and they aren't required to publish their financial statements. They also have more flexibility in how they form their administration, including the ability to customize shareholder agreements, define voting rights, and set rules for succession. Management itself is composed of shareholders, many of which are actively involved in the day-to-day operations and decision-making of the business. In some cases, shareholders may also serve as directors or officers of the corporation. If not, they may choose to have a separate board of directors or none at all. If the corporation chooses to have them, their job is to watch over the corporation, make decisions, and appoint officers. Officers are responsible for the day-to-day operations of the corporation. They follow direction from those above them, manage employees, and make sure the corporation follows any laws and regulations. Now, how the corporation flows as a whole is going to depend on their bylaws. It would be hard to run efficiently if nobody knows what they're supposed to do. Well, bylaws help solve that. Bylaws help clarify the roles and responsibilities of shareholders, directors, and officers. shareholders, how meetings are to be run, how finances are handled, what the amendment process looks for bylaws, and really anything else that needs to happen to make sure the corporation runs smoothly. Now, another thing that helps things run smoothly are meetings. In a closed corporation, shareholders and directors typically meet at least annually to talk about the corporation, make any plans for change if necessary, elect directors, and review finances. Now, being transparent about finances is important in this structure. Financial reports must be given to shareholders periodically so that shareholders can see visually how the business is doing and to help with making decisions for the corporation. While yes, shareholders are responsible for what happens in the business, a closed corporation is a separate legal entity from its shareholders. This gives shareholders liability protection, meaning that shareholders generally are not personally liable for what happens within the corporation. Now, we haven't talked about taxes yet, and that's because taxes can roll two different ways. Generally, when a closed corporation is formed, it is taxed as though it is a C corporation or C Corp. C Corps go through something we would call double taxation. This means that the company's profits are taxed at the corporate level, and then when dividends are paid, the shareholder pays taxes again on that income they receive at their individual tax rate. So what would this look like in action? Well, say my corporation makes $100,000 in profits for the year. Now, on those profits, the corporation needs to pay income tax. As of 2024, that tax rate is now set at 21%. That means the corporation will pay $21,000 in corporate taxes. This then leaves $79,000 in after-tax profits. So let's say there is an agreement where I get all the leftover profits. Not likely in the real world, but hear me out. Once I'm given that dividend, then I'll need to report them on my personal tax return. So assuming I'm in the 35% tax bracket for qualified dividends, that means I'll owe an additional $27,650 in taxes on the $79,000 in dividends. Now, in case you couldn't tell, this scenario is entirely made up, but you see, it shows you that both entities pay taxes on the same profits. That's how C Corp taxes work in a nutshell. Now, I want to add that a C Corp has the option to retain the profits instead of distributing them, although they would still owe corporate income tax on those profits. Now, closed corporations can be taxed another way entirely. They can choose, through completing Form 2553 with the IRS, to be taxed as an S corporation or S Corp. This way, corporations avoid paying that corporate tax altogether. Instead, all profits or losses pass through to the individual shareholder's tax return, where that amount is then taxed at the shareholder's individual rate. Now, S Corps go about this by providing shareholders active in the business a salary. Say in my tutoring business, I made $60,000 in revenue. After I take all of my business expenses into consideration, I'm left with a net profit of $50,000. Now, out of the S Corp, I pay myself a reasonable annual salary of $45,000. I'll get a W-2 and pay self-employment taxes on that income. That will then leave me with $5,000 of net profit within the company. Now, at any point throughout the year, any portion of that remaining net profit can be transferred into any shareholder's personal checking account as a distribution or owner withdrawal, or whatever was agreed on within the bylaws. Those remaining profits can be reinvested back into the business too, without having to worry about taxes right away. Now, when it comes to determining a shareholder's salary, the compensation must be considered reasonable for the work performed, taking into consideration what someone else working in a similar industry and position would be paid. Now, the figures I used were made up for the sake of simplicity, so be sure to do your market research to make sure the salary doesn't raise any red flags with the IRS. Now, in case the business isn't profitable in a tax year, that loss can be used to reduce taxable income for the shareholder from other sources, like wages, investments, or other businesses. But it's important to remember the amount of loss that can be deducted is typically limited to the shareholder's position in the S Corp stock and debt. If the losses exceed the shareholder's position, they may be carried forward to future tax years. Now, despite its benefits, closed corporations aren't perfect. There can be some drawbacks as well. For one, since these entities don't participate in public trading, raising capital can be challenging, potentially limiting the opportunity to take on larger projects or expand the business. Then, not being in public trading, shareholders looking to sell their interests in the corporation may find the process trickier and longer than public corporations. And finally, administration issues. Remember earlier when we talked about the different roles you'll find in a closed corporation? Well, while shareholders wearing different hats in the corporation isn't necessarily a bad thing, that overlap may lead to some conflicts of interest and disagreements among shareholders. Conflicts have the potential to throw a wrench in the decision-making process, disrupting how the business is run, and in extreme cases, legal issues if the disagreements aren't handled properly. So how does a closed corporation measure up to their corporation counterparts, a C Corp and an S Corp? Well, similar to an S Corp, closed corporations aren't publicly traded, so you or me couldn't be shareholders without already having an in to the corporation. On the other hand, C Corps do trade publicly. Anyone can be a shareholder, and there is no limit to the number of shareholders they can have. Now, when it comes to the number of shareholders either corporation can have, a closed corporation is vastly different. While a C Corp has no cap, an S Corp caps their limit at 100. This is significantly more than the max of 30 in a closed corporation. In a way, their structure more closely resembles an S Corp by their less formal structure, and their benefit to small and medium-sized businesses. This is much different from a C Corp that favors the larger businesses and has more formal structure. So, how can you start your own? Well, the exact steps in forming a corporation vary from state to state. There are some that for the most part are universal, so we'll go ahead and go through those steps together. First off, you need a name for your business. And while it may seem like a no-brainer, I still have to say it. Make sure it isn't already taken. Well, a simple Google search should do the trick. To be extra cautious, you can check out the online database of your Secretary of State or Department of State's website. Most states have a searchable business entity database where you can check out existing business names. If you want to be really thorough, you can also search for trademarks on the United States Patent and Trademark Office website to see if the name is registered federally. From there, you can go about registering your name too. Then gather your shareholders so you can start preparing your articles of incorporation. This is like your application to be a corporation. Be sure to include a clause stating your intention to register as a closed corporation. Now, this is going to look different in every state, but in my state of Pennsylvania, it's just an added sentence. It states, neither the corporation nor any shareholder shall make an offering of any of its shares of any class that would constitute a public offering within the meaning of the Securities Act of 1933. That's it. Along with that clause, the other information in it is pretty straightforward, like your corporation's name of all shareholders, purpose, and registered agent. Incorporation fees are going to be due with your paperwork. While fees vary from state to state, they'll typically run from $50 to $300, depending on where you are incorporating. You need to draft and adopt your corporation's bylaws. These bylaws are the commandments for your business. They outline the internal rules and procedures for operating the corporation. Bylaws typically cover things like the responsibilities of the shareholders, voting rights, and outline how the corporation should run. As with any business, depending on what you sell or offer through your corporation, you'll need to make sure you are getting any required business licenses, permits, and registrations at the federal, state, and local levels. This could include the Employer Identification Number, or EIN, sales tax permits, and opening business bank accounts in the name of the corporation. Now, depending on how you choose to be classified, you may not need to do this step. But if you want your closed corporation to be taxed as an S Corp, you're going to want to make sure you file Form 2553, called Election by a Small Business Corporation, with the IRS. It's important to do this within 75 days of incorporating. Now, I know this can feel overwhelming. Believe me, as a business owner myself, I've been there. But starting your own business doesn't have to be a frustrating process. Sure, you could do it all yourself, or you can let the professionals handle the hard parts for you. Now, personally, I chose the latter. There just weren't enough hours in the day to get everything I needed done. And to be honest, I was in over my head. So I knew I was going to need some serious help. After some soul searching, I found ZenBusiness. ZenBusiness can help you with just about everything in your business. They can help you with your taxes, getting business licenses, opening business accounts, and even setting up a website for your business. I used them to set up my LLC, which I felt was quicker and less stressful on me than when I started my sole proprietorship by myself. Their corporate application is done in just 5 steps, and overall takes around 5 minutes to get from 1 to 5. The first section is to enter your business name and select the state you'll be operating in. From there, you'll need to answer some simple questions about your business, like if you plan to hire employees in your first year, if you have prior experience, plans, what you plan to do or sell, and what stage your business is currently in. Now, there's no wrong answers. These questions are used to help ZenBusiness understand what you need so that they can help. Before your application can be completed, you'll need to choose your plan with ZenBusiness. Right now, they offer 3 different options to choose from depending on your needs and budget. If you got this whole business thing down to a science and just need some help getting it all together, then starter plan may be the right fit. With the cost of, well, free, it's definitely budget friendly. Your only obligation would be the cost of the state filing fee. This option gets your application forwarded to your state with a 2 to 3 week turnaround. And ZenBusiness will double check your application for any errors so you can have peace of mind that it's correct. And as a bonus, they offer worry-free compliance that covers your annual report filings with the state with up to 2 yearly amendments. But this benefit is only free for 1 year before the $199 a year price tag would kick in. All in all, if you have significant business experience and time to spare, this option could be just the right fit. If you're looking for a bit more support, the Pro plan may be a better option. Coming in at about $200 a year plus any state fees, you'll get everything offered in the starter plan, except filing turnaround is rushed to 2 to 3 business days rather than weeks. With this option, they'll also help you out with getting an EIN and forming your corporate bylaws.
Now, if you're looking for help with it all, like I was, the premium plan for $300 a year will help you with everything the previous plans will.
Along with business document templates like liability waivers and employment agreements, a website builder, a domain name, and a business email address. So you see, starting a business doesn't have to be a stressful process. It can be quick and efficient, taking as much time as making a cup of coffee in the morning. So having said that, I see ZenBusiness as one of the best business formation services out there, especially for beginners like me, because they take care of everything on your behalf. Now, don't get me wrong, there are other great services that I've also tried, like Taylor Brands, LegalZoom, and Swift Filings. So I'll go ahead and leave some review videos down in the description if you want to learn more about them too. Now, when I was starting my business, we were going through the worst of the pandemic. I was being furloughed from my teaching job, and the resources I needed to help from my state weren't there. So I was thankful ZenBusiness was able to help me to get started on the right path so I could still do what I loved in my tutoring business, teaching. Getting started with them, I knew I was going to need all the help I could get from them, so I chose the premium plan. Now I understand it is the more expensive of the 3, but I feel like the benefits they offer outweigh the costs. So just a quick recap before we wrap things up. A closed corporation is a type of corporation that has under 30 shareholders and doesn't sell stock to the general public. These business structures are common with family-owned businesses where shareholders are generally involved in day-to-day operations. Closed corporation shareholders get limited liability protection, separating their personal assets from the happenings in the business, and they have the opportunity to choose how they are taxed. They can choose to pay taxes by pass-through taxation, like an S-Corp, where all profits or losses pass through to the individual shareholder's tax return, where the amount is then taxed at the shareholder's individual rate. Or they can be taxed as a C Corp, where the profits are taxed at the corporate rate and then shareholder dividends are taxed at their individual tax rate. And that's it for today's video. I really hope you found this video useful, and if you did, please hit the like button and subscribe for more. And as for those discounts I mentioned at the beginning of the video, if you want ZenBusiness to help form your business, check out the affiliate link in the description for discounts you wouldn't be able to find on your own. And also be sure to check out my in-depth review of ZenBusiness. Also, feel free to leave any questions in the comments below, and I'll try my best to answer them as soon as I can. Thanks again so much for watching. We'll see you next time.